Live from the Business RadioX studio inside Renaissance Bank, the bank that specializes in understanding you. It's time for North Fulton Business Radio.
Hello again, everyone. Welcome to another edition of North Fulton Business Radio. I'm John Ray, and folks, we are broadcasting from inside Renaissance Bank in beautiful Alpharetta. And if you are fed up with the mega bank experience that your small business is getting, it involves not being able to talk to a live person, for example. Well, Renaissance Bank has got a different way of approaching their business customers and even their small business customers. They do it in a personal way. They're big enough to handle pretty much any need you can throw at them, but they're delighted to work with you personally.
Yeah.
If that's the kind of experience you want for your business when you're dealing with your bank, then go to renaissancebank.com, find one of their local offices, and be in touch. And I think you'll be glad you did. Renaissance Bank, understanding you, member FDIC. And now I want to welcome Mark Hutchins. Mark is with Good Friend Mortgage. Mark, welcome.
Thank you.
Yeah, great to have you here. Let's talk a little bit about you and Good Friend Mortgage. How are you serving folks out there?
Okay. Good Friend Mortgage started about 20 years ago. Debbie Switz is the owner, and it's a broker, and meaning that we are very nimble. We can go out and get various different products to best serve our clientele. And if we don't have it, we can surely go shop it and look for it and establish a relationship with that particular lender. Started out with we make home happens is their motto.
We make homes happen?
Yep.
I like that.
We make homes happen. Mm-hmm. And it's gone to where you're just not a customer. You become a good friend after dealing with us.
Very nice. Very nice. Before we get deep into the work you're doing there and Good Friend Mortgage, let's talk a little bit about you. You've been in the mortgage business for quite a while. What keeps you at it? What keeps you enthusiastic about this work, Mark?
Okay. I started out in the late 70s. And if anyone on the...
You're seasoned.
Yeah. If anybody listening can remember back that far, that interest rates were skyrocketing at the time.
That's right.
18%, 12%. I remember back in the early stages of Rocket Financial, Dan Gilbert. He was just down the street from me in Detroit, and he promoting that he had 11.78 interest, and everybody was all excited about that. So in the current environment, the sixes are not that bad. So.
Yeah, right. For sure. Yeah. But you've been at it a while.
Yep. And then I had a 20-year absence where I went into a different career. Mm-hmm. And when that career ended, and about 20 years ago, I gravitated back into lending. It was something I knew, and I still had context into that environment. So.
Mm-hmm. Gotcha. What is it that there are a lot of mortgage companies around? There are a lot of mortgage professionals.
Right.
What makes Mark different?
Mark takes the file and thinks of himself, meaning, how would I like to be treated during that file? How would I like to keep up to date? How would I want a person handling my business to handle it? And I go from there and making sure every which way I could find a way to do it, if possible, to get it done and get to closing.
So let's get into, Mark, some of the specifics of what's going on these days. And one of those, there's still lots of construction going on, and you do a lot of work in the construction area.
Right. That's where I, here in the last year or so, seen where that's an opportunity for our market, because as far as the resale or the used house market, it's been pretty tight. People haven't been wanting to put their house up. If they have to, they do. But there's really affordable housing, or even housing to meet their needs. The big gap being filled now is by the builders, and there's a lot of building going on, and it has been for several years now, and they're expected to be another 8-9 years before they meet demand to fill that gap. So I have various programs that will be able to fit that need, whether it's the borrower themselves or the builder. So it's rekindled as opposite of what it was there during the '08 recession when a lot of them were going out of business.
For sure. And so what are you seeing out there in terms, you mentioned, I guess, middle income housing. What are you seeing there?
The problem here in Atlanta is you got to go quite far out to be able to get it. And starter home is now up near $400,000. So that lends to itself different styles of construction, and we could do modular home and manufactured home, but that's going to be further out. So you're still getting the big homes being built in this particular immediate area, but there are some more projects going out to where it is smaller. And the problem is your two biggest engines within the mortgage needs right now is the Gen Z and the millennial and the baby boomer, and they all don't want the mega mansions. They want small, but you got a lot of local building codes that are wanting to protect the neighborhoods that they have already built, and they're not allowing that type of building or density building to happen, and you got to do it more of a higher density. So that's some of the challenges that we have right now. Yeah,
those are significant and continue to restrict supply, as you implied.
They're not going too far because they don't want the prices to go down.
You've got some thoughts about those folks that they've been out of corporate for a while, they're self-employed, maybe independent contractors, or they've got their own business. Right. Talk about how you work with folks like that.
They fall in, and generally the guidelines state that a person has to have a particular self-employment type income or 1099 for a period of 2 years to be able to qualify to justify, because they want some kind of track record. But there's if a person's a W-2, they could get it on a Tuesday and apply for a mortgage on a Wednesday, and they'd be fine. But with these other folks, and it's growing since COVID, you get more people that have gone into the contract world, the 1099, or started up their own business, their own whatever, that it would tag them as self-employed. So there's programs out there that as long as there's assets coming in and a steady stream of assets, there's a calculation that's done to determine how much of that can be used to call before income. So they can qualify for a mortgage. It's generally called a bank statement. And it could be 24 months or 12 months, depends. There's different programs for that, and where they can purchase a house or get a home equity loan, or they could get a cash out refinance or whatever based on that stipulation and those criteria.
When you say assets coming in, do you mean income coming in?
Yeah. Where they can show they got a steady stream, and they show you can do a short P&L and what kind of money's coming in.
Okay. Does this speak to the need that a lot of business owners, I would think, should have to have an S corp, because where you can pay yourself salary, and it makes it easier for someone like you to help get them qualified?
Well, if they do 1120, where they're actually a corporation and they pay themselves X amount of money on a steady basis on a W-2, that's a much simpler process, and they can get a typical mortgage doing that.
Right.
And then there's some that go a different route and different filing, whether it's Schedule C or 1120S, that they have to go this other route. Because a lot of times people, the way they do their taxes, they might have income coming in, but that have to be deducted. And there's a whole calculation that's done with that type of borrower to see what the net income is. It's not the gross, it's the net.
Right.
So there's things that are taken off and added back in, and based on the tax filings.
Yeah, but I guess the point is, at the end of the day, wherever someone is, you can work with them.
Right.
It's just a little more complicated when they're a 1099 or self-employed.
Right, and we have the programs for that as well as the standard programs.
Folks, we're chatting with Mark Hutchins. Mark is a lending consultant at Good Friend Mortgage, and you're working with, I think when people hear the word mortgage, they automatically go toward owner-occupied single family home, right? But your expertise goes beyond that.
Right. You can get a Fannie or a Freddie, and those are the government agencies that back a mortgage, as well as FHA. But you can go and you can get those type of programs, and you're fine. You can do it with a primary owner occupied. You can get that programs for investment property, and you can get that for second homes. And that's fine if you want to go down that route. A person wants to go down that route. But there's other programs passed that doesn't necessarily have to look at income to get a particular property if it's investment. The second home, you can go through the normal stages, but there is for that investment property where people are buying real estate to rent out or a multitude of other things. There's other programs for that.
So let's talk about, here's something that'll keep people put people to sleep probably, but it's the kind of thing you pay attention to on behalf of your clients, which is why we need guys like you. Debt service coverage ratio.
And that's particularly what I was alluding to here just a second ago. That is where somebody can either pull money out of an investment property that they're renting, or if they want to purchase new, it's as long as the income on it covers the net, or the net income covers the debt of what is going to occur by getting the mortgage, the principal, interest, and the taxes and insurance on it, you can get a mortgage on that. There's programs for that. And then the borrower doesn't have to give the income justification, no tax returns, no paychecks or whatever on that program. You don't need that to qualify. They still have to have a good credit score. And if they don't, I can help them get to that point, what they need to be, but it doesn't need to have income looked at for that particular program.
Gotcha. How do you handle situations where folks are looking to consolidate debt?
Well, we have a number of different debt consolidations avenues. People's hesitation now is because we had so long of the 2s, 3s, and 4 interest rates, and now that they're higher than that, they're hesitant. But there's a couple different routes, or several different routes we can go. I have a blending calculator, meaning taking the debt that they have, what the interest rates are on that said debt, and how long a period they're paying on it, and combine it with the mortgage and how much is left at the mortgage in that particular rate, and it'll calculate what the blended rate is. If it makes sense to do it that way and do your typical cash out refinance, we can go that route. If it doesn't, we can do a home equity loan. That's where it amortizes. Or we can do a HELOC, which is a home equity line of credit, where they can consolidate it in there. And those tend to be floating interest based on what the prime is. And if that makes sense, we can go that route. So we got a lot of different options to take a look at to where people can solve their high debt, because what's happened after the stimulus checks stopped and people were doing good about paying down debt reduction and all that during that period of time. But since that time, debt in the United States is skyrocketed. People I've seen people with $1,700 car payments and paying 30% interest on credit cards. And that adds up if you're not paying it off without occurring that interest being to your balance. So we take a look at that to see how we can help people. And that's a big thing right now, but it's all the mindset that you have to get over, because people don't want to let go of that cherished low rate. And it might not be that cherished when you look at it in the big picture and all combined. Yeah.
So just to be clear, and this is what I heard you say, and it makes perfect sense, is that folks are reluctant because they've got that home equity loan at 2 or 3%, and they see whatever the rates are now, depending on what their situation is, and they are clutching onto that. But if you blend in their entire debt picture, it makes perfect sense to give up the 2 or 3 in order to get a lower blended rate on your whole debt. Through a home equity loan.
And then you have more, you can increase your cash flow. Now, if you can withstand the higher cash flow, And some people can do that. You can make that debt even shorter period of time than it otherwise would have been.
Mm-hmm.
So you could pay off your mortgage. Your home mortgage might have been 30 years. You can maybe pay it off in 12. So that's a great savings of interest, accumulated interest too.
And you're getting, for some of this debt, I presume, some of those folks have got debt that's not, the interest on which is not tax deductible. So you got to factor that in too, right?
Yeah, they're not getting the benefit like they used to.
Right.
So
yeah, that makes perfect sense. Equity access loans.
That's where
what is that?
That's equity is where you can access the equity, and a lot of business people can do it against their property. It's just basically the same thing that we were just talking about. It's accuracy and equity, and there's other ways that we can do that behind your cash out refinance standard. There's other products. There's home equity lines of credit, home equity loans, that type of thing.
Gotcha. And this is another aspect of what your work is all about. You do commercial mortgages as well, correct?
What we can do is, for, let's say, the construction loans, I can do ground up construction. That means a builder goes in and they want to build the house. They're funding the building of a single house, or up to 4 is typical. How different houses on a tract of land, small tract of land. And then we even have programs for production builders as well as spec home builders. And it also covers custom builders. So depending on theirs, they can go get the lending. And that's some of the commercial lending or multifamily that we do. We can do fix and flip, like a multifamily units up to 30 units are some of the lenders that we deal with. We can do that. So that's the commercial side that we basically park in.
Yeah. So talk about the rate buy down program. So first of all, what is a rate buy down for those that don't know that, and talk about the programs you have there?
Lenders are offering a 3-2-1 and a 2-1 buy down. And that's where in the first year, let's say on a 3-2-1 buy down, let's say the interest rate is 6%. In the first year, that interest rate to the borrower would be 3%. The second year, it'd be 4%, 5%, and then it would go to the note rate after that.
Right.
And that is generally funded by the seller. It's big in the builder industry, where the builders offer that program, the 3-2-1 or 2-1, and basically what it is, prepaid interest. So they're covering it. And it can also be done in the resale market with seller concession. Seller concession can cover that. The seller concession, the seller doesn't care what you do with the money that they're basically given to you. So there's another ways that we can look at it, whether we can buy it down permanently, the rate down permanently, or do a factor several things, because you can always get a refinance after the 3-2-1. And if you want to permanently buy it down, maybe that makes more sense. It depends. Everybody has a different mentality and risk tolerance on what they do. So maybe rates will go down, maybe the rates won't go down. So those are the things you can look at. Then there's one lender today that came out with a program that's connected to first-time home buyers, the Home Ready and the Home Possible, that they fund the 2-1 buy down, meaning the prepaid interest on that. It's part of the program, so you don't need seller concessions on that. So that's an advantage for some people that don't have the cash total to cover everything. It gives them a benefit.
Yeah, that makes perfect sense. So what about those folks? Are they still out there that fix and flip? Plenty
of those around that want to go into a property, whether it's multifamily or if it's the 1 or 2 or whatever size house that they have, whether it's duplexes or the quads or whatever they want to go in, or a single family. But they can go in and they get a short-term funding to fix it up to where they want it, and they flip it and then they pay it off and go on to the next one. And so we have several programs that will be able to cover that type of scenario, and it just depends on how that particular borrower and their business model matches up to what the lender is offering. So those are good programs for the investor out there that wants to keep on doing the fix and flips and go on to the next one. And then you can get a permanent mortgage if they decide to keep it.
Sure. Now, one of the things that I think it's important to point out here, you talk about these different programs. You basically, you and Good Friend Mortgage, you're the company that you're a part of. You're dealing with companies that have lenders that have a wide variety of programs, lenders that aren't affiliated with you. So you've got the ability to go out and pick what you think is the best option for your borrowers, depending on their circumstances.
Correct. So, yeah, we go out and we just establish the relationships. We get a feel for how they treat different things and how it goes on there. So you're not just stuck, in a sense, with one underwriting thought. You have different ones that you can go to. You get to know them and see how they operate and what they're going to accept, what they're not going to accept, and then that dictates where you would direct a particular file to them. So
right. I think some people have this notion that it's really important that they have a mortgage with their financial institution, their bank, their credit union, whatever, and that somehow that's having a situation where their mortgage is different than the rest of their financial situation could be negative for them. And
right.
And that's you're going to disabuse us of that notion, I assume.
There's several institutions, there's a lot of them that we have an agreement on how we access them and have them, your sponsor, we have an agreement with. So,
yeah, there you go.
It just depends. And then, so it just gives a lot bigger choices to go to and look at and see what the one where you bank is the one that comes out the best and it's the best all around. And it's not only rate driven.
Yeah.
That's short-sighted looking when you look at rate only, because there's a lot of other factors in getting lending that you need to be looked at and compared to, because you want to do the old adage, apples to apples. And so even showing that to a professional like me is a benefit, because we can go through and we talk that language. We know what the best, if it's a good deal, fine. If it's not, we might be able to search and get a better deal.
Yeah. Yeah, that makes a lot of sense. You mentioned the prices of homes in the North Fulton region and beyond and where they have gone. And so that brings up the issue of jumbo loans. How do you define a jumbo loan these days?
Jumbo loan is anything higher than the maximum Fannie and Freddie loan amount, which is $766,220.
Okay.
So if the mortgage is bigger than that, you jump into the jumbo loan. Now we have to take a look at it there, because it could go to you take a Fannie Mae, let's say, up to the maximum, and then you do a piggyback second on it. That might be to the benefit to the borrower over just getting a straight on jumbo. And then the higher you go. So you just got to look at and have somebody look at a comparison to make sure what makes sense, because I've done it both ways. You get to the bigger loans, $1 million plus, it might be better just to go ahead and get the jumbo loan. And depending on the program, it might be a little bit higher than a standard mortgage because there's more risk, or it could be not that much different. So it just depends on the different programs out there and the way they're treated. So
Got it. Mark, talk about the clients that are best fits for you.
Generally, I've seen I'm involved in the chamber and a lot of other business networking. And I tend to get a lot of business people or professionals. And around here in Atlanta especially, you got even the young people, your Gen Xers and your Gen Zs and your millennials that get high-paying six-figure jobs early on right out of college. So I've dealt with quite a few of those that work for the tech companies and the big companies, engineering companies, as well as I've done several small business, and it was part of the reason coming in with, they had more access to help those type of people, the self-employed, the business owner, and then because of what I saw is the construction business going out there, growing bigger and bigger. That's where I gravitated, initially just doing construction to perm, which is where the borrower gets the loan for the construction. And then when the construction, it's an interest only, during that construction period. And once they get a certificate of occupancy, it goes into a regular mortgage.
Yeah.
So basically, that is a program that goes over 12 months. And then if you need more, the building somehow got slowed up, you can apply for an exception. So that's some of the ones that I've been going to. And then since going with Good Friend, I have the opportunity of doing those ground up construction, stabilized bridge loans and stuff that are popular with the builders.
I think it would be great at this point if you could share, Mark, a success story, one that helps illustrate the great work you're doing.
I had a business owner here about a couple years ago. Man had 9 companies, and his own bank, and you mentioned that before, his own bank was sitting on the file and not doing anything and was confused by it. I got it, took it down, compartmentalized, figured out what was going on, went through and did all the calculations you need for income, and got him a standard loan on his farmhouse, his big estate. Mm-hmm. It was just a matter of taking the time, breaking it down, seeing what his status was, and getting the information. And this was during the tail end of the COVID era, where banks were a little tight and wanted a lot of documentation, more than usual.
Right.
And we got through it. Had to work with his business his business manager, but we got the things that we needed, and we got him the loan that he desired on his primary home.
Wow. Great story. So, Mark, this has been super. Lots of great information here. I think at this point, probably some folks may want to be in touch. So let's tell them how they can do that. Yeah,
always give a check and always look, and I can always see what I could do. But yeah, basically reaching out to me, you can go on goodfriendmortgage.com, and then I'll be under the lender list. You just click on Mark Hutchins, and then you got the information. You even have the ability to apply right from there. Also, my email address is Mark, M-A-R-K, at goodfriendmortgage.com.
Mark Hutchins at Good Friend Mortgage. Mark, thanks so much for coming in and sharing your thoughts.
Thank you for having me.
Yeah, it's a pleasure. Hey, folks, just a couple of quick things before we let you go for today. If you are looking for an Italian restaurant that is classic, authentic, and traditional, but is also food to table and was food to table before that was cool, Casa Nova is the only Italian restaurant that fits all those requirements. They've been around since 1998, and for most of that time, they've had a garden behind their restaurant in which they bring in those fresh tomatoes and corn, zucchini, peppers, herbs, and they make their dishes right there in the kitchen, cooked to order. It's a fantastic place, and they treat you like family while you're there. CasanovaItalianRestaurant.com is where you can go to find out more information, and be sure and check out their catering. They do terrific work there that we've taken advantage of here at North Fulton Business RadioX, and you'll be glad you did, and those party guests will be glad you did as well. Also, folks, I've got a book out. It's called The Generosity Mindset, A Journey to Business Success by Raising Your Confidence, Value, and Prices. Now, if you're a solopreneur, small professional services firm, and you've got issues in understanding the value of what you do, and pricing to that value, your positioning, you've got business development issues, this book is written for you. Go to thegenerositymindset.com to learn more and learn where to buy the book. Also, I just want to thank you, our listener. You make it happen for us. You've supported us now for well over 8 years as we've been doing this show. We're coming up on show number 800 for North Fulton Business Radio, and we've only gotten this far because of you and your support. Thank you for that support and for helping us live into our mission to be the voice of business in the North Fulton region. So for my guest, Mark Hutchins, I'm John Ray. Join us next time here on North Fulton Business Radio.